Hey guys, Jordan from Precondo here. Today we are going to talk about why I think Toronto condos are still incredibly undervalued. We're going to talk about a project cancellation that recently broke the news, rising construction costs, and where I think prices are headed in the near-term future. And we're going to go through some recent condo sales and look at what they sold for back in the day and look at what their gains were over that period of time. If you want to book a call with me to talk pre-construction, you can do that at precondo.ca, and let's get into this video. I'm going to try to keep this one short this time. All right, so this is going to be one of my least structured videos ever. I just want to share a bunch of different stuff that I've been thinking about the past couple of weeks here. First thing I want to talk about is just we're in a seller's market, an extreme seller's market. There is nothing on the market. Like, it is incredibly difficult to be a buyer's agent right now. You know, I do primarily pre-construction, but we have resale agents on my team who specialize entirely in resale. And look, like, it's really difficult to be a buyer right now. Whether you're looking at freehold or condo, I feel for you. There is nothing on the market, and the particularly good units get scooped up really, really quickly in multiple offers. So very reminiscent of 2017. So if you're not familiar with months of inventory, it distills whether you're in a buyer's or seller's market. Anything below 3 months of inventory is a seller's market. So as you can see here, we're at 1.3 months of inventory in the condo market and trending downwards. And we're at 0.9 months of inventory, meaning there's less than a full month of inventory on the freehold market. Just incredible sellers markets across both freehold and condos in the 416 right now, which is interesting because I thought downtown was supposed to be dead. I thought we were never recovering. The market obviously shows a very different story. This chart is what I really want to focus on here, and this was from Twitter. It was just the last 2 years. So the last 2 years of price appreciation across a lot of different markets in Ontario. I distilled it into the markets that are of most interest to me. And we'll start with condos. So you can see Toronto condos as a whole, meaning all of Toronto, 16.7% in the last 2 years. CO1, if you're not familiar with the MLS names, they have all kinds of different districts and stuff. CO1 just means the downtown core of Toronto. You're looking at 11.8% over the last 2 years. Now, obviously, we saw a dip in price, and then we've seen a recovery and then a little bit of growth since then. But overall, over the 2 years, you're looking at 11.8%. So we've barely, at these new inflation numbers, we've barely kept up with inflation, right? But then you start to look at, areas sort of outside of the downtown core. So W06 is the Humber Bay, Mimico area, Alderwood, and you're going to see 29.3% growth in the last 2 years, which just goes to show people are paying a premium for parkland, getting a little more space for a little less money outside of the downtown core. And then once you get into detached housing, you'll see the GTA as a whole averaged 40% over the last 2 years, which is just, record breaking. Niagara saw 57.2% growth. London, St. Thomas, 60.1%. You've got Cambridge and Brantford near 60%, Barrie at 60%, and then Bancroft down here at 91.5%. So huge increase in rural property, Blue Mountain, Collingwood, those areas doing incredibly well as people are working from home and looking for more space outside of the core, right? But of course, what I see here is opportunity in the downtown condo market. Obviously, things are starting to return to normal. And if you don't think that's the case, if you think work from home is here to stay in some massive way across all the market, obviously, I've got a bridge to sell you and none of it. I think, yes, it's going to accelerate some work from home trends. Yes, we're going to see some hybrid models. We're going to see a decrease in space needed by the big corps downtown. But overwhelmingly, we're going to see the majority of people come back to the office, if not for, full 5 days a week, 3-4 days type of thing. I think it's just a matter of time, but that's just my take on it. I could be entirely wrong. The surveys I've seen of executives and CEOs seem to agree with me. And when you look at the vacancy rate downtown, it's obviously skyrocketing for office space, but it's not as bad as you would think, right? So we look at vacancy downtown, and this is from Colliers, and you see that we are currently at, for the downtown core, we are at a vacancy of 7.1%, which is very high. Pre-COVID, we were around 2.5-3% vacancy downtown. But it's worth noting that pre-COVID, that 3% vacancy rate was decades low, right? So you go back 20, 30 years, 7.1% isn't that rare. And furthermore, we were at one of the lowest vacancy office markets in North America, and we still continue to be today. So if you look at other major metros in North America and you look at their vacancy rate, let me just blow this up a little bit. So for example, New York, 10.7%. Boston, what are we at? 14%. Seattle, 15.3%. Chicago, what's our sister city looking like? It's at 19.2%, right? So 7.1%, very, very good, all things considered, on the worldwide, or rather North America scale. Now, the last thing I want to talk about before getting into specifics here is just the price gap. And I talk about this every video because it is important. Detached has ran so much in value, and condos have traded sideways, and we're right back at our all-time high. So we're right back at $1 million price difference between your average detached in the 416 and your average condo. So with affordability being such an important factor in a market, where do you think that capital is going to flow when people start working downtown and whatnot, and people start flooding back into the city? Well, obviously the most undervalued type of housing, which is condos, right? That's the most affordable segment of a market. That's where capital flows easiest, and that's where you see prices push up easiest. So naturally, when things start to open up and people, start moving back downtown again, I've already got clients who have bought out in, the suburbs and in Barrie and in Collingwood and whatnot, who are looking for condos to lease downtown because they're being called back to the office. I think this is a trend you're going to see start to continue. And to me, that's just bullish for condos downtown. Like, freehold is averaging almost 1.8 million in Toronto, and condos are 740,000. Right. So to me, it's only natural that the next thing we see sort of a repeat, right? A repeat of 2016-17, where either detached corrects downwards or condos appreciate upwards in order to close that gap to a more historical normal. And on the note of affordability, I'm going to pull up the UBS report, because when I talked about the UBS report in a previous video, I actually failed to point something out to you guys. And this is what I failed to point out. So in the affordability or the price to income ratio section of the report, Toronto is actually looking really good. So Toronto's down here towards the bottom of the report, looking at about a 6, the number of years that a skilled worker needs to be able to buy a 650 square foot condo near the city center. We're about a 6-year price to income ratio, whereas Hong Kong's at 20 years, London's at almost 15 years, Tokyo's at 12.5, 13 years. Singapore, you get the idea, right? From an affordability standpoint or price to income ratio, which is one of the 5 metrics that UBS uses, we actually look really good, attractive compared to the other markets included in the report. Now, like I said, we're starting to see people come back to the city, which obviously adds demand to the market, to the local market, but also immigration, right? So September, for our PR number, we saw, I believe, the highest month PR admissions in 100 years. So we are on track to hit our immigration target of 401,000 this year, which means that we should be able to achieve our 411,000 target of next year, which is, of course, the highest immigration we've seen in Canada in a long, long time. And new housing supply just is going to continue to fail to keep up with the demand on that side of the market. Now, I want to quickly pivot to recent sales and what they sold for back in the day, and then we'll pivot into a project that recently canceled that made headlines, as well as rising construction costs. So first unit here, unit 905 at 1410, so sort of in the 1410 DuPont, so sort of in the Junction region. Nice unit, right? Sold for $615,000 2 days ago. Last sold for $520,000 in 2018. So you're looking at a compounding annual growth rate of 5.75% annually over a 3-year period. Next, we have this unit here, downtown, sold for $750,500 2 days ago. Last sold for, we'll go all the way back to 2009 here, $316,000 in 2009, representing 7.47% compounding annually. Then we got 390 Cherry in, Distillery District here. This unit sold for $730,000 2 days ago, and it last sold for $462,000 in 2017. So that's 9.58% year over year since 2018. Obviously an incredible, or since 2017 rather, obviously an incredible return. The East End is doing quite well lately. Next up, we have a unit here in Mississauga, 339 Rathburn, sold for $591,500. Last sold for $325,000 back in 2016. So you're looking at 11.5% over 5.5 years. 781 King, so in the entertainment district, sold for $735,000. first sale of 211,000 back in 2005. So this gives us a little bit of a longer term average. You're looking at 8.1% compounding annually from 2005 to today. So 8% a year, pretty incredible. Next up, we have 1030 King. So in the entertainment district, sold for $625,000. And it sold for 441 in 2017. So you are looking at 8.06% year over year. 5 Hannah, so a nice loft unit. You can see here, it sold for $861,000, and it sold for $459,900 in 2013. So you're looking at 8.4% year over year. 8% keeps so the longer term you're looking like 10 12 years, you keep seeing 8%, and of course the narrower the window, the more impact something like COVID's going to have. So you're going to see 5-6% type of thing, with some exceptions, and we'll get into some of those. I'm going to skip this one. Got 15 Beverly. This building has particularly brutal maintenance fees. Anyways, sold for $650,000. It is a really nice building though, boutique with a rooftop pool, but sold for $650,000. Last sold 2018 for $560,000, putting it at 5.1% year over year. Again, narrower the window, less growth you're going to see on an annual basis because COVID's going to impact more. And then you get into exceptions to the rule. For example, particular neighborhoods that have done really well. This is in Humber Bay, a pocket that has done very well through COVID. So this one just sold for $670,000, one bed and den in Humber Bay at Eau de Soleil. Last sale was 2019 for $509,000. So from 2019 to today, we've gone from $509,000 to $670,000. So you are looking at 14.7% year over year through COVID. 33 Charles just sold for $722,000 3 days ago. And last sale was back in 2014, I believe, probably right after the building registered, $410,000. So you're looking at 8.42%. Over 7 years. Then we've got this really nice loft unit just sold for $1.33 million. And the oldest sale on record here on House Sigma, 2004, for $396,000, which puts this just shy of 8%. So 7.4% year over year over a 17-year period. That is an incredible return on investment. Then you've got 33 Bay, right in the heart of the financial district. Well, I guess a little south, but you get my point. $678,000, sold for $470,000 back in 2017. So you're looking at 8.5% year over year over that period of time. And the reason I show all these comps is, again, there are articles saying condo prices are down, average price is down, median price is down. When you look at specific units and look what they sold for before, you look at recent sales and look at sales from a year ago, mid-COVID, obviously you're going to see price growth on it. Comparing direct comparables to each other, we do not see the picture that prices are lower than pre-COVID. We see quite the opposite. It's just a varying degree of how much the units have appreciated, which is very dependent on building and neighborhood. Now, a quick note on rental market. This is from Zealand on Twitter. We are still, so you can see here, this was like the worst part of COVID, just tons of condos on the market for rent, 20% lower rental rates than pre-COVID. And now we're hovering around that 8,000 to 9,000 listings on market, which is above our long-term average trend of about 4,000 units on market. Which at first glance, it looks like the rental market is still pretty brutal. That isn't really the case on the ground. So there aren't rental units are moving quite quicker than they were for a while. So while the listing volume is up, so is the transaction volumes. So you look at how many leases happened in the CO1, just the downtown district, in October of 2021 this year. We saw 984 leases versus 2019, 2018, and 2017, typical years pre-COVID, saw around, low 700s. So our lease volume is up considerably. Yes, there's more inventory on the market, specifically in high-rise buildings, but that inventory is dissipating relatively quickly. So we should start to see rental rates, especially with this immigration. Hopefully we'll start to see those rental rates recover in the near term future. Now, shifting focus to pre-construction just a little bit here. What's interesting with pre-construction is the projects launching outside of the core, Burlington, Oakville, Barrie, Hamilton, are doing particularly well. They're doing really, really well, actually. They are fetching, price per square foot that those neighborhoods have never seen before. A lot of that has to do with construction costs rising. And some of that has to do with the fact that obviously there's a lot of mania about buying in the suburbs, buying outside of Toronto. Toronto's dead. Downtown is never coming back. So buy your investment condos in these outskirts areas. You get more square feet for less. There's more upside. I would disagree. I would say because condos in Burlington are up 35%, 40% in a year, or in 2 years rather, I would say there's probably way more upside in the downtown core. But it is interesting to note that we're now seeing, $1,000, $1,100 a foot in uptown Oakville, Dundas and Trafalgar area. Burlington's getting $1,000 a foot. Hamilton's getting $900, $950 a foot. Barrie as well. That's really interesting to me because you can buy in Midtown Toronto, a 20, 25-minute bike ride to the downtown core, or a 5-10 minute walk to a subway line. You can buy pre-construction in the Midtown areas like that, in good neighborhoods, for $1,100, $1,150 a square foot. So that's really interesting to me because, again, I see a market dislocation where if you're looking for pre-construction specifically rather than resale, there are some serious opportunities at lingering inventory at these projects that launched a year or two ago, which can be really smart investments, provided they are already under construction or by a large reputable developer, because the risk of cancellation is quite high on anything that's launched at 2 years ago pricing but hasn't broken ground yet, because the construction costs have rose so rapidly in that period of time that those margins for that developer may be gone, and they may be forced to cancel those projects. And I think you're going to see, we're already seeing a fair amount of that. And this is what I'm talking about here. We're looking at a 10% increase in high-rise construction costs over the last year, which obviously eats into developer margins, which means they're forced to cancel the project in many cases. And we just saw that happen up in Barrie. There was a townhome project, and they canceled. They had no choice to cancel because, cost of construction rose so rapidly. The prices that they initially sold at can't be honored anymore. And so they came back to the buyers and said, well, you've got two options, right? You can either give us $100,000 more to cover the cost inflation in the materials, or you can walk away from your contract and get your money back, get your deposits back. Well, obviously, if you have $100K or can scrape together $100K, the value of your townhome in Barrie in the last 2 years has risen, 40, 50, maybe more than that percent. And so that $100K is actually more than profitable to just fork over to the developer. But this is obviously incredibly frustrating as a buyer. And I think it's something, it's one of the risks of pre-construction, and I get into the risks more and what happens in cancellation and how to mitigate your risks, how to buy from developers and make sure they have zoning and approval, make sure that they're going to break ground soon, that type of stuff at precondo.ca/guide. It's a full 50-minute video on everything you need to know about pre-construction, so go watch that. But basically, the point I'm getting at here is, if you refer to one of my earlier videos, I had said that there's definitely risk in projects that sold pre-COVID and then prices rose and they haven't broken the ground yet. I did say there's going to be some risk in those projects, and it's just inevitable at this point. Obviously, developers in Ontario operate on really thin margins, and this isn't to point out this developer specifically, because let's be real, this is affecting the market as a whole. And just the larger a developer is, the more financial resources they have, the more likely they'll be able to honor the original contracts. But at the end of the day, if they can't get a construction loan, because the construction loan has terms, right? You have to hit a 15 or 20% profit margin. You have to pre-sell 75, 80% of your inventory. And of those units that you pre-sold, 80% have to have mortgage pre-approvals in. And they have all these contingencies that basically, if a developer can't get that construction loan, then really they truly don't have a choice but to cancel the project or to ask for more money. So this is something you're going to continue to see on anything that's sold pre-COVID. There's a little bit more risk there than there was before, just because, again, you lock down the economy for 2 years. It's really hard to open back up, and you get all these supply chain issues, and developers hold off from launching. And this is actually a bullish signal in a weird way, because this is going to mean that there's less new housing supply completed and there's less new housing supply launched, as developers are a little bit more fearful about these supply chain issues, which means that, 3, 4, 5 years down the road, there may have been, let's just hypothetically, maybe there were 30,000 new homes that should have come to market or completed in 2025, and now there might only be 25,000 because of the cancellations. And so to me, immigration's increasing, new housing supply is harder to bring to market. that's a bullish signal for price appreciation at least, but you certainly don't want to be one of the buyers in the situation like this. And that is why you should watch my guide on how to mitigate risks. That is all for this week, guys. I will see you guys next video.